Hello, everyone, and welcome to another episode of Advisor Insider. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. I'm talking today with Jake Miller, who is the co-founder and Chief Solutions Officer at Opto Investments, a private investments platform. We're going to talk about private equity and private credit investing through, I guess you'd call them wrappers, ETFs, and maybe some mutual funds and stuff like that. It's a little bit of a nuanced strategy, but it's gaining some popularity. It's certainly gaining popularity by the issuers. Wanted to get Jake on here to talk a little bit about how this might work, what some of the challenges and what some of the opportunities might be. Jake, how you doing? Welcome to the podcast.
Thanks for having me, Jeff. Doing great.
Tell us a little bit about Opto Investments, first of all.
Yeah, so I founded Opto with Joe Lonsdale, one of the founders of Palantir, founded Adipar in the wealth tech space, and runs 8VC, top quartile venture firm out of Austin and San Francisco. We founded this together 4.5 years ago now, having both seen the growth of private markets
Mm-hmm.
and the lack of tools for fiduciaries in the space. And so I was coming from Bridgewater Associates, the macro fund, and saw firsthand how a lot of the interesting transactions were moving from public markets, which we traded, onto the private side. And Joe, as chairman of Adipar, saw just how hard it was for fiduciaries to build robust, scalable, and efficient programs to access this, large, growing, we think high potential area of the market, but one that comes with a lot of complexity, a lack of transparency, and a lot of operational headaches that have historically kept people away from sort of what we think of as appropriate portfolio concentrations in private markets.
Okay. We're going to talk about this through the prism of exchange traded funds, talking to probably mostly financial advisors or people that are trying to allocate to private investments through exchange traded funds. I wrote a couple of stories over the past week or so about two companies that have launched strategies in an ETF wrapper. One is the PEO Alpha Quest Thematic PE ETF, ticker is LQPE, that is investing in, I guess, kind of like proxy performance of using equity derivative strategies to generate performance that is private equity like. And then there is the Pacer PE/VC ETF, ticker PEVC, that is investing. This is kind of unique too. This is investing in publicly traded companies to generate performance that would be comparable to a private equity or private equity and venture capital portfolio. I mean, this is something that us in the kind of information business refer to as retailization, because we don't think of private equity and venture capital as being a retail product. You have higher minimums usually, you have higher fees, you have much, much less liquidity than you will have in ETFs and mutual funds. But there is always a case for why people who aren't in that high net worth category or institutional investor might want or need access to these types of strategies. What are your thoughts on that? And I don't initially I called it a trend, but I don't know if it's a trend. It's an ongoing thing, the sort of the retailization of these other products. What are your thoughts on that in general?
Yeah, I mean, it's a great question. It is a big space. This story is really, it's been unfolding for really about a decade now, but I think we're still in the early innings of what it means to bring private markets to a broader audience. And so this started with just more access points and feeders, then, the growth of BDCs, REITs, INO funds,
Hmm.
and tender offer funds, which can open this up to accredited investors, and then ETFs, which can obviously go all the way down to mass affluent and just sub AI investors.
Hmm.
But I think it's really important to zoom out and say why would you do private markets at all?
Hmm.
Um, you have these public markets out there; they're totally liquid. There's a ton of transparency. Uh, you some
Hmm.
might argue too much, but regulation to protect investors, et cetera. Well, the reason to me is Well, twofold. One, there is real diversification to be had. These tend to capture different slices of the economy in terms of sectors, in terms of company size. Tend to capture different parts of the economy in terms of sector, company size, exposure to foreign versus domestic, and to loan size, to creditor status, et cetera. And so there's good reason to believe, just from a pure sort of beta portfolio maximization standpoint, you're getting diversification, and all else equal, that should be good for your portfolio.
Hmm.
To me, the bigger piece of this, though, is the potential to generate alpha. And this comes from, I think, a pretty common sense understanding of what drives alpha overall. In my book, there's really four ways to outperform markets. You need to have unique information, unique access, unique insight, or you need to get lucky. We can all hope to get lucky, but in public markets, the first two are illegal. That's insider trading. So you're really relying just on that unique insight. Every public market hedge fund is trying to be the smartest person in the world today. And not just that, but get smarter than everyone else every day. It's a pretty hard game. It's the
Hmm.
reason there's not a ton of persistence in hedge fund outperformance. That's very different on the private side. Access and information are the lifeblood of private markets, and you see a lot of serial correlation between top managers fund over fund, as they compound on the benefit of seeing deals first, of having more information about sectors, of knowing who the best founders are. Imagine if you were known as the best healthcare investor in the venture space, and two of the best founders, repeat founders, great product market fit, were coming to market. They're probably going to call you first because having you on the cap table is a
Hmm.
good mark on their company. Um, but you already also have more data on the healthcare space. Potentially other portfolio companies could be sellers to or buyers from that new company, and so you tend to continue to win in that space. To a limit, when funds grow too fast, when key partners retire, when there's team and strategy drift, those things tend to fall off. But you can, with a lot more certainty than a hedge fund, think that, if a fund is top quartile, this fund, the odds that it is top quartile over the next five funds are much better than a coin flip.
Hmm. Okay.
Um, so getting access to alpha in a sustainable way, and that's where I get worried about some of the retailization plays. Like when you talk about recreating venture-like returns using public market companies, you're sort of inherently removing the ability to add unique information or access because now we're back in public land and that's illegal.
Right.
Um, or, in not quite at ETF yet, but in some of the largest BDCs, they're deploying billions of dollars every quarter. There's only so many companies that can absorb that amount of loan flow, and so you end up looking a lot like the high yield index. And I
Uh-huh.
just wrote a piece on that last week. And
But
so,
what's driving the recent focus on private markets? It's these private markets have been around for a long time. Obviously, they've been around as long as public markets have been around. Why is it's suddenly something that financial advisors are being
yeah.
I guess asked about?
So I think it's push and pull, Jeff. So the push is some of the biggest players in the space, Blackstone, Apollo, KKR, have invested a lot in creating products for a broader retail market.
Hmm.
These tend to be very large funds. They can take a lot of capacity. They have hundreds of wholesalers who fly around the country telling advisors they need this. And, eventually some of that sticks. And then there's a bit of the FOMO of if everyone's doing it, people don't want to be left behind.
Hmm.
On the pull side, I think it's two things. One, more and more, if you read the front page of the Wall Street Journal, it's not talking about public companies that you can just go buy. Half or more of the page might be on the private side.
Right.
And I think, investors have come to expect, hey, if I'm reading about this, if I have ideas on this, I should be able to participate. And if it's private, I don't know how to do that. And so wanting that. And then, I think those who are looking at portfolios consciously are looking at the last few years and looking back to paradigms like the 70s, like parts of the 50s, and saying, hey, stocks and bonds don't always diversify each other.
Hmm.
And we seem to be probably in a rising rate period, not falling rate period. Maybe I should add some more legs for my portfolio to stand on.
What is let's go to your outlook for the private markets the next few years, and what asset classes look interesting if we are talking about that. Then we'll talk about maybe if it makes sense for these things to be
Yeah.
wrapped inside of ETFs. But As an investment, what's your outlook?
Yeah, and look, private markets are as varied as the public side, and so it's hard to say I'm bullish or bearish private
Hmm.
overall. Within private markets, I'm sort of split in credit. Smaller lenders have been able to step in where regional banks pulled back in 2022, getting really
Hmm.
attractive yields with strong covenants and collateral. But large lenders are competing against each other and have the weakest covenants we've seen in over a decade. And so I sort of draw a line at about $100 million loan size. Below that, I'm pretty bullish. Above that, I'm pretty bearish.
Hmm.
On the equity side, I think there's going to be winners and losers. And so we're still working through a lot of the pain from companies over raising at too rich evaluations in 2021, early 2022 on the venture side. That money is starting to run out, and people are having to come back to market and either accept down rounds or find other ways to finance themselves through to a potential upturn. And that's created a real lack of distributions in VC, which is weighing on the whole industry.
Hmm.
Now, if you can look through that, we do think there are really interesting opportunities at the seed stage right now. We are at the beginning of a AI transformation wave, and I don't want to sound like a hype guy. Like tend to be more on the contrarian side of things, but this is going to be transformational, probably more than anything across traditional industries. How can we make logistics more efficient by optimizing lots? How can we make healthcare more efficient by having patient data flow naturally and having billing work much more efficiently? So some pretty boring applications,
Hmm.
but things that have been really waiting for this kind of technology to come along. Very few of those applications exist yet, and probably more importantly, the picks and shovels that will actually build this revolution are yet to be built. That's developer infrastructure, database management, everything that goes into, powering an application that then feeds off of OpenAI. And so we're really bullish on deep tech at the seed stage, thinking about it sort of like how the cloud computing wave happened over the 2010s.
Hmm.
In that wave, the Amazons and Microsofts of the world bought a lot of these early stage companies at really attractive valuations as acquisitions to power their overall infrastructure. So we think a really similar setup there in venture. And then, private equity, I think extreme winners and losers over the next few years. We have heightened economic uncertainty. We have the threat and actuality of tariffs. We think that's likely to mean a lot of capex and reshoring of manufacturing capacity. Private equity tends to be very manufacturing and sort of lower middle market focus. So actually, really bullish for those in that space who know how to monetize that. Probably a lot harder for firms in like the growth equity space, as software companies tend to have the most exposure to overseas, both in terms of sales growth as well as developers who work in other countries, and also the chips that are, as we know, not manufactured here yet.
Hmm. What are your thoughts on providing retail investor access to these markets? Whether, I guess, lowering the thresholds or requirements for retail investors to gain access, or through something packaged like an ETF, which would certainly, change the underlying. You can't just put private equity inside an ETF. As I mentioned, there's the two ETFs I referenced at the top of the show is they're essentially giving you proxy performance, hopefully. But what are your thoughts on, I mean, should retail investors be able to access these markets the way other people can?
You know, I mean, the my definite answer is yes, but the devil's in the details on how.
Hmm.
And so, it is, if not impossible, very difficult to make something that's fundamentally illiquid, fundamentally
Hmm.
liquid. And if you
Right.
have, a couple tens of thousands or hundreds of thousands, I would not recommend locking a large portion of that money up in something illiquid. You might want to buy a house. You might need to finance something. Um, I don't think people in that wealth bracket are at the point yet where it makes sense to potentially have 10-year wait time on getting their money back,
Hmm.
even if it has potential upside. And so, my advice number one would be focus on what you're getting. As you very astutely call out in your articles, like these are not private markets products. They are replications of private markets,
Hmm.
and their expense ratios are pretty high. And that's kind of interesting because they're not holding anything different than uh, your average ETF in terms of underlying.
Right.
They're all public. and yet are charging investors more. And so, be cognizant of what you're buying and how much you should pay for that. You should pay for alpha. You generally shouldn't pay very much for beta. Um, and then, be cognizant of the fact that, again, I think the real opportunity for outperformance comes from being truly private and being able to leverage uh, unique access and unique information, which as of yet, you wouldn't be able to do in an ETF because they're just buying those public market companies. That said, I have heard some interesting ideas and reports for the defined contribution space. So, yeah, the defined contribution space,
Mm-hmm.
where people are thinking of creating products that it'd be one fund and be sort of a total portfolio solution. And the Department of Labor did issue a notice that up to 12.5% of that portfolio could be private. And so we're
Okay.
we're very excited to see some people coming to market in the next few years with a portfolio that does include a truly illiquid sleeve, but within an overall liquid allocation that investors might actually be able to access in their 401k.
Mm-hmm.
Now that setup I like a lot because 401k is long-term money. You
Yeah.
can't access that. You have to wait till retirement, and so that seems totally appropriate if you're going to lock up any capital to lock up that you have to wait for retirement anyway.
I like that too. What do you think about, or what's your outlook for these type or any types of ETFs that are trying to provide private equity, private debt, venture capital like returns in something as transparent and liquid as an ETF?
You know, I think it'll depend so much on what the overall market does.
Mhm.
Because what essentially these amount to are they're high beta plays. It's essentially leverage on an underlying asset to make it look more like its private counterpart. If markets
Mm-hmm.
move in the right direction and inflation cools down and the Fed cuts rates and risk assets generally perform, these will perform and they'll look like they justify their fees and everyone will look smart and the investors who invested will feel good. I don't think that's the world we live in. I think we are putting on a ridge. There are steep hills to either side between us
Mm-hmm.
and the hole. And I think levered beta right now is not the bet I would be taking. And thus, like, if we get and I'm not particularly bearish right now in the economy. I just think expectations are very high. But let's say we get a 4% equities year, bonds sell off a little bit, risk sells off a little bit. These are going to drastically underperform actual BDCs that hold private underlyings, which really won't mark that much. There probably won't be that many defaults. Instead, you're
Mm-hmm.
holding leverage exposure to something that is marking, and that differential performance, I think, could sink a good handful of these.
Okay. And then finally, are there other ways that you can think of that retail investors can gain access to private markets or I guess private market type exposure? We kind of talked about that a little bit, but I thought I'd just try and wrap up with that.
Yeah, I'd say it's evolving quickly, and Opto is, we are part of that evolution. We aren't quite at market with a full, as easy as an ETF option, but it is on the roadmap here. And I'm sure it's on that of other folks in the space.
Mm-hmm.
There are avenues to dip your toe. As an example, there's a number of websites where you can buy and sell shares in venture-backed companies.
Right.
And usually those ticket sizes can be relatively small. I think if you could call 5% of your portfolio, almost an entertainment budget, but you want to learn about private markets and maybe you do well. If you can find things where the minimums are low enough that you can do that, there's other firms like Yield Street that allow some of this on the debt side. I think that's a totally reasonable thing for investors to try out as they move along their wealth path and as they move from net worth to accredited, from accredited to qualified client and into qualified purchaser, they might have a better sense of what they're looking for in private markets and who they want to partner with if they start early.
Okay. Good stuff. Good things to think about. Like I said, there are a couple of ETFs out there already offering what they are pitching as a proxy of private equity performance. We've obviously detailed with Jake's help how this is, they are not exactly the same thing as directly investing in private equity. Uh, but stuff to think about, stuff to keep an eye on. I expect to see more of this because there seems to be a big push in that direction from the issuing side. But on that note, I want to thank Jake Miller of Opto Investments. I want to thank our audience, financial advisors. Go to ETF.com and see what we have there in the Advisor Center and all the other coverage we have on ETFs and portfolio management. And I also want to take the time right now to thank ETF.com because this is my last Advisor Insider podcast. I am retiring at the end of this week, and going to try that whole retirement thing. We'll see how that goes. I still might be out there freelancing a little bit, so you might see my name and stuff here and there. But want to thank everyone. I'm thinking that Advisor Insider is going to be on a pause, maybe restarted at some point. But until then, this will probably be the last one for a while. So thank you, Jake, and thank you all for listening.